Okay, you know about that SEBI data. And there's the second one, which is where you are breaking even. That is around 4% of the traders. And congratulations, you have moved into the bracket 2. And then once you control it further, you are now seeing a consistent returns, and now you are in the top 1% of the traders. Good day, ladies and gentlemen. It's 13th of February 2025. Love is in the air, but for our markets, it is volatility with a capital V in the air. I remarked on my Telegram channel a day after the budget that market may come down to the pre-budget levels after the euphoria dies down. And unfortunately, exactly same thing has happened this week. Let's not get into I told you so syndrome. Rather, our focus has always been on how you can earn in every kind of market scenario with the same strategy and with the same set of rules. There are plenty of reasons floating around for all the volatility: rising rupee rate, tariff war, overvaluation of Indian stock market, and so on. But what is the use of all these explanations if your hard-earned money is already lost? For those who are wondering, we ended up profitable once again during this week, but a small profit of 0.3%, and that is fine with us. For a week where market just kept moving down by almost 1,000 points, and we are trading with a non-directional strategy of short strangle. But despite that, it has been 2% profit for January and 1.2% profit for February so far. Now, experts do change their strategies as per the market conditions, and I salute them wholeheartedly. But what about the common traders, and especially new traders? They get even more confused with all the different commentaries in the market and more complex adjustments. Now, one may feel that you are the only loser, but the truth is even experts lose money, but they won't tell you that, will they? Here we share one single and simple strategy for shifting short strangle, or Nifty Strangle 2.0 as we call it, with same set of rules and real-time updates on the free Telegram channel. The link is in the description box below, and you may consider joining it. And well, if you have just stumbled upon this video, make sure you watch the previous videos to understand the strategy and the adjustments. In the nutshell, we start by selling the weekly strangle with strike prices which are far OTM, and then keep closing in or shifting the strangle day-wise. The adjustments are simple and easy and takes once in a day in the morning, or if the market reaches the predefined trigger points. Coming to the main topic of this video. This is one key aspect you must learn if you intend to make money as an option seller in the long term. Now, you may have heard the concept of going up by the stairs and coming down by the elevator. So this is the profit chart of an option seller, where you can see that you make profits more often but in small steps, and then comes a nightmare, the big fall. And it is this big fall or the big movement in the market which can actually make or break your trading strategy, and this is one thing which you must focus on if you need to improve your overall strategy. Now what happens is that over a period of time, as you can see, you are making more number of profit trades, but those small big losses are actually bringing your profit into the loss territory, and overall your capital is just going down. Now you need to understand that these are the points, these are the falls which are the most critical ones to control for the option sellers. If you can control them, gradually what happens is that you will start making a no profit no loss in your overall strategy. Your profit and loss will be balanced, and you will end up with the same capital as you have started off. And what's happened thereafter, once you control your moves further, your losses further, what will happen is that is when your graph will start going upward. You will see your capital moving up with consistent profits. So what happens is that you see the first variety wherein your capital is gradually decreasing. Well, that's about 95% of the traders. Okay, you know about that SEBI data. And there's the second one, which is where you are breaking even. That is around 4% of the traders, and congratulations, you have moved into the bracket 2. And then once you control it further, you are now seeing a consistent returns, and now you are in the top 1% of the traders. Coming to the day-wise details, so on 7th of February, it was a Friday. Market had opened around 23,650. It marginally moved up very close to 23,700 or so, and then fell down around 250 points to the low of the day, around 23,450, and closed around 23,550. Now, Friday was a pretty easy day for us because we take our strangle at 1200 points on the upside and 1500 on the downside. And on this day, the triggers were not touched. The daily triggers that we have at 225 points up and 300 points down. So this is the actual listing of our Telegram channel. And if you see on Friday, by around 9:25, market was very close to 23,587, and this was our strangle 24,700 and 22,200. This is around 1,200 points up and 1,500 points down, and these were the triggers: 23,900 on the upside and 23,250 on the downside, which is around 225 points up and 300 points down. So on that day, it looked like this on the chart. The dark line represents actual strangle, and the dotted line represents our adjustment trigger points. However, on that day, nothing further had happened, so triggers were not touched. So we carried the positions overnight, and there was a good decay in the premium on that day. So Monday again, now what we do on Monday is that we close the strangle further, and we bring it down to 1200 on the downside and 900 points on the upside. And the adjustment trigger points are at the same distance from the strike price, 300 points down, 225 points up. And this is how we marked it freshly for Monday. As you can see, the dark line and the dotted line are the real actual strangle and the adjustment trigger points. On Monday also, the trigger points were not touched, so we carried the position overnight. And on this day, however, VIX rose by around close to 5.5%, and the premiums were quite low for that day. So we moved on to the next day, that is Tuesday, 11th of February. 11th of February was there were a lot of bearish undercurrents in the market. There was a lot of negative news that were floating around, and Sensex expiry was to be on Tuesday. The rupee had hit all-time new low, and however, 925 we took the position as it is. That is, we closed the strangle further to 900 points on the downside and 675 points on the upside. Those who are not able to comprehend these gaps of the strangle, I'll request you to go and have a look at my previous videos where all these points have been explained in detail. That will really help you in understanding the strategy. This is what it was marked on the map, on the chart that day. We had the strangle at 22,400 on the PE side and 24,100 on the CE side, and the dotted line of 23,000 and 23,650 represented our triggers on which the adjustments were to be made. Now Tuesday was a very fantastic day as far as the movement of the market was confirmed, and at around 2 p.m. our lower trigger was indeed touched. And if you can see, this was a live update. Yes, at around 1356, the market was around 23,048, and at around this time only it has hit the lower trigger point. So what we did was effectively we just shifted the entire strangle down. What it means is basically closing the old strangle and shifting the entire strangle down at the same gap from the present strike price. That is, on Tuesday we follow 900 points on the downside and 675 points on the upside. Now since it was done around close to the closing time of the day, around 2 p.m, and market closed around 23,071, so nothing much was required to be done. We just rebalanced our strategy, we just redrawn our strangle and the adjustment points, and thereafter we carried out no further adjustment and carried the positions overnight. The MTM was still intact despite market falling from all the way from 23,700 and broke around 23,700 points. Market had already fallen. However, despite that, our MTM was still in profit at around 0.2% of the value. So going ahead, this was February 12th, that is a Wednesday, and the market had opened around the same level, 23,050, and so we held on to the previous levels and the previous trigger points, because on Wednesday we don't close the strangle further because a bigger move will bring us very close to the expiry related volatility. So on Wednesday, as a rule, even if we have to make an adjustment, we still maintain the same distance we maintain on the Tuesday, that is 675 on the upside and 900 points on the downside. Now on Wednesday, everybody was of the opinion that since Sensex expiry is over and RBI has taken certain measures to obviate the negative news regarding the rupee hitting all-time low, it is going to be a flat day or not much volatility was expected. But all of us was in for a surprise. So around the moment it opened, it kept falling, and by around 10:15, within 1 hour, it has already hit our lower trigger point. This was at 9:30. This was the market situation, you can see, and our lower trigger point was at 22,800, which we were carrying forward from the previous day. And by around 10:16, if you can see on the screen, the Nifty spot has already reached 22,800, and we had to close the old strangle and shifted it further down with the same gap of 900 point on the downside and 675 on the upside. So this was our new strangle which we had created at around 10:15 on that day. So entire strangle has been shifted down. Now even despite our adjustments and market falling very close to around 900 points or so within the week, we were still in green. As you can see, the PNL, the strategy PNL, we were still at 0.2%. So we didn't had a major loss by that time, and we carried forward our positions. And this is what we remarked on by around 1 o'clock, because the market had already started making a very sharp recovery after momentarily crossing 23,800, 8.300 points down, and thereafter it recovered around 300 points up. And this phenomena is very rare. Obviously, market make V-shape recoveries or E-shape recoveries, but moving to this range, and that too on a day when there is no expiry, is quite surprising. But ultimately, all your strategy should be strong enough to take care of these surprises. And anyway, our upper trigger point of 23,150, which we thought was very far away when we had adjusted, that also came under threat. Market actually breached 23,100 and went up to 23,144, so 6 points short of our upper trigger point, and that is the point we decided to shift the strangle up. And as you can see from today's movement, the market actually followed up its up move. So that is how the strategy actually saved us. So this was our new strangle. Nothing much, it has just been shifted up, moving along with the market, and our new strangle was at 23,800 and 22,200p. So By this time, what has exactly happened was that all these adjustments, actually you incur losses on every adjustment. So the MTM profit, if you see, although it is still in green despite having suffered so much with the big movements in the market, was still in green. So that was what I wanted to highlight here, that you keep shifting your positions with the market, and at the same time you keep maintain that gap of safety distance from the market. So now this was exactly the movement of that particular day. You can call it V shape or a reverse N shape, but market had actually moved 800 points intraday on Wednesday. That is quite a rare phenomena, and a simple option selling strategy like plain vanilla strangle, you could still get out without making any losses. By the end of the Wednesday, by around closing of the market, the combined ATM straddle premium was around 174. This is a very good indicator of the volatility expected in the market on the next day, and 174 is a bit higher than 150, which would be the ideal level, but nothing much. However, we saw on Thursday that market made a movement on the higher side in the beginning, and thereafter drop down to almost its initial levels. We'll come to Thursday on that. Anyway, we were expecting the market to be, after having made so much of moves, the market to be tired on Thursday, and maybe the traders will get a breather. Whether that happened or not on Thursday, you are all aware. Anyway, what is more important is by the end of Wednesday, we were still in profit, of a decent profit, nothing much, but around 0.1%, and we were still in green. So, coming on to Thursday now. So Thursday, that is today, the spot was around 2350 at around the opening time, and on Thursdays we take a gap of around 550 on the downside and 400 points on the upside, and the trigger points for Thursday we keep as the midpoint from the strike price to the strike prices of the strangle, which is there, to the present market spot price. This is how it looked like on the map, on the chart, and as you can see, clearly see the kind of movement we had on Wednesday, and the green candle of Thursday was just starting at that point of time. Now going forward, when the market was at around 9:30, we saw a sudden spike of the ATM straddle combined premium, and which was moving a bit on the higher side. So the premiums were not actually decaying at that point of time, marginally high, but still. So MTM was on the Thursday morning was around 0.2%. So that was okay. Our positions were nicely balanced at this point of time. So we move forward. However, market chose to keep going up. By around 10 o'clock, market was very near to 23,150 level, which was a very important level. Actually, this 150 level and 220 to 250 was a very important level as far as the market was concerned, to be taken as a reference only. And we decided that in case the market for the next 15-minute candle stays above 23,150, maybe we have to shift the strangle upward. And by around 10:15, although market sustained above 23,150, but there were other indications like the ATM straddle, the premiums were not shooting up that much. We decided that to give an advice to the conservative traders, in case they are not feeling comfortable, to shift the entire strangle 100 points up. However, I decided to hold on to the positions for further confirmation. And as we moved ahead, we saw that around 10:45, the ATM straddle combined premiums had started to decline, and that gave us a fair indication that maybe the top is nearby. So that's all for the day. Nothing further happened. Market momentarily crossed the 23,200 mark, but thereafter it started falling, and the fall was although quite severe, and it went back to again to 23,000. But luckily, since our the lower strike price of our strangle was at 22,500, we had nothing much to worry about, and we had a peaceful expiry by the end of the day. Our overall profit this week was almost very close to 90,000, which amounts to 0.3%, and that too within so much of volatility in the market. So that is a very good personal achievement for me. So this was the gist which I posted at the end of the day, that it was an eventful week. 1,000 points down move, a V-shaped Wednesday and a A-shaped Thursday. So a small profit of 0.3% for the week. So around 2% for the January, and for February, although 2 weeks have passed, we are maintaining around 1.2%. So overall in 2025, that is by the time I have started this Telegram channel and posting all my trades live, we are in a decent profit of 3.17% for this month. So that's all for this week. However, I will request all those who are new to kindly go and see the previous videos to understand the strategy and the adjustment, which are very simple, by the way. And apart from that, in case you like and find some sort of a substance in the videos, please do like, share and subscribe, and share with those who are actually making constant losses in the market, so it will give them a lot of confidence. So thank you, thanks a lot.